Hi, I'm Nina Melendez, and welcome to LinkedIn News Live, a show about the world of work and our place in it. Prices for food, gas, and housing have hit record highs, and to combat this rising inflation, the Federal Reserve hiked the interest rate by 75 basis points, the biggest increase in nearly 30 years. Advocates of the tightening say rising prices is the greatest risk facing the economy right now, but others say a recession is worse. Well, joining me for this conversation is my co-host for the day, LinkedIn Chief Economist Karen Kimbrough. Karen, hello.
Hey, Nina. Thanks for having me today.
Oh, good to see you. And we're pleased to welcome our featured guest, Mary C. Daly. Mary is the President and CEO of the Federal Reserve Bank of San Francisco. President Daly has spent her career in various roles at the Fed, such as a research economist and vice president. She received a Master's of Science in Economics from the University of Illinois Urbana-Champaign and a PhD in Economics and Public Policy from Syracuse University. President Daly, welcome.
Thank you so much for having me. I'm delighted.
So good to have you here on LinkedIn News Live. Let's start with inflation, which is on everyone's mind, weighing on our pockets as well. It's persisting at a 40-year high and quite far from the Fed's preferred range, despite many economists initially saying that it would be transitory. What is driving it, and can the Fed address it?
So let me start with, yes, the Fed can address it, at least partly. And what started it is really COVID, the pandemic. So coming into the pandemic, we had inflation of about 1.8%, and we had a strong growth rate and a strong labor market. And then we got the pandemic, we all went home and had to stay home. And that really constrained the supply of goods and services. But we had money because many of us were teleworking, so we were still getting a paycheck. And those who were not as fortunate to keep their jobs had support coming from the federal government and the state governments to get them through, which was exactly the right thing to do. But it left more demand than the economy could support with supply. And when you mentioned that many economists and policymakers thought this was going to be transitory, well, we actually did think it was going to be transitory because we thought that with a vaccination scheme that everyone would get vaccinated, including all the global citizens, and we would beat back COVID far more quickly than we have been able to. But that hasn't happened, and that is a surprise. And it leaves us with supply still very short and only made shorter, especially in energy and food, with the war on Ukraine. And so we end up with way more demand, and that's a technical term, a lot more demand with too few goods and services for us to purchase. And the natural consequence is we have high inflation. So the Fed is about treating that part of it. While we can't rebuild supply chains and we can't release strategic oil reserves or get the wheat out of Ukraine, we definitely can change the demand. And that's about 50% of the high inflation we see. So we are working towards that as quickly as we possibly can. And hopefully Americans everywhere will start to see some relief in their pocketbooks.
So Mary, last week, Chair Powell stated his sort of unconditional commitment to taming inflation. Has the Fed put price stability ahead of full employment? And if so, what would that mean for jobs in America?
Well, let me first assure everyone that that is decidedly not what we have done. So we have a dual mandate, full employment and price stability. And the dual mandate, while it's two things, actually is a singularity of goal. And the singularity of goal is a sustainable economy that durably works for everyone. But when we have prices of food, energy, housing at unsustainably high rates, this will bridle the economy if we don't pull it down. And so if the economy gets bridled, whether it's through inflation or another force, then we don't achieve the full employment that we really have committed to. So an unequivocal commitment to price stability is foundationally an unequivocal commitment to full employment. So I'd rather everyone leave today, if you could leave with one thing about inflation and the Fed's work on that getting price stability is actually a fundamental factor in being able to achieve full employment. People need jobs, but they also need to depend on day after day their income that they earn from those jobs growing their well-being, not shrinking as they go forward. So that's the commitment that I have as a Fed official, and I never speak for my colleagues, but it is a shared commitment we have as FOMC participants.
So you're a labor market economist, and I really want to ask you how you're reading the labor market right now. Where we sit here at LinkedIn, our data suggests that it's still pretty strong. We see hiring, growing about 10% relative to the year before. Maybe there's a little cooling in that momentum, but it's still pretty strong. How are you reading the labor market?
So I read it just like you described, that it's really strong right now. And in fact, as we think about Fed policy and the impact that will have on the economy, I think the labor market being as strong as it is really a strength, right? We have households, spending is good, incomes are good, and the labor market is strong. That means we are raising interest rates on an economy with a lot of momentum, and that puts us in a much better position to achieve a softer landing, one that delivers the outcomes we want. So I see a strong labor market, much like you do at LinkedIn, and I see people getting jobs and looking for jobs, and firms still having trouble filling those jobs, despite the fact that the economy, we're raising the interest rate, and most people expect the economy to slow slightly.
Speaking of that, President Daly, many economists feel a recession is nearly inevitable with this amount of expected tightening. Are we headed for a recession? And if so, how bad could it get? When do you think we'll get there? Let us in on the secret.
So my outlook for the economy is that we will have slower growth. But remember, we're on a high base, so we'll have slower growth. That could fall below what we're used to. So we're kind of used to 2% growth is what we would expect. So I wouldn't be surprised, and it's actually in my forecast, that growth will slip below 2%. But it won't actually pivot down into negative territory and leave us for a long period of time and leave us with year-over-year growth that is not really growth at all, but a shrinking economy. That's not my most expected outlook. And with that slower growth, I do expect the unemployment rate to rise slightly, but nothing at the proportions like we've seen in what people would think of as a recession. So we're really not talking about unemployment rising, to to high levels as much as just a little less pressure on the labor market that we see today. I mean, right now, the labor market has an unemployment rate that's near historic lows. And so getting it up just a couple of tenths does not tip us into a recession. It simply means a softening of the robust growth we're seeing today. So, the way I think about this, if I may just use a minute to talk about an analogy or a metaphor, I never remember which it is, but, I think about when you're younger, you're riding your bicycle down a steep hill and you can get too much momentum, and then you have two options. You can sharply put on the brakes and you'll likely go over the handlebars, or you can tap on the brakes and slow to a speed that's more sustainable. And when I look out there in the economy and with our policies that we're taking and I would support, I see us tapping on the brakes to slow to a more sustainable pace rather than slamming on the brakes, going over the handlebars and having the proverbial recession.
I love that analogy, by the way.
I do too. This is a really interesting time to be setting policy. You have the challenges of high inflation we talked about. You've got the challenges of tight labor markets or strong labor markets. There's a war going on. The Fed is also starting to reduce the size of its balance sheet. There will be elections coming up soon. How much does the Fed take into account like the external events that are either happening overseas or are sort of a little outside the wheelhouse of the classic economic indicators? How much do you take those into account when you're thinking about how much to tighten or when to tighten?
Sure. So the starting point for policy, and I think this is really important, and it's something that I've had to learn how to manage over my now 25-year career working at the Fed. But the starting point, of course, is we have two goals: full employment and price stability. And then our job is to ask, how can we get there as quickly as possible? How do we create a durable economy that achieves both of those goals simultaneously? And of course, you've named all the factors that could disrupt those. So a war in Ukraine, it affects consumer sentiment, of course, but it also creates what we call a global headwind. The global economy is not going to grow as fast because of these supply constraints from the war in Ukraine, and that's going to be a headwind against U.S. growth since we do a lot of trading with our partners. So absolutely, we're looking at that. We're also looking at the patterns of COVID, especially in the global economy, because even though we feel a little bit more confident here in the U.S., in China, they've just come off the lockdowns that persisted for almost 2 months. And so we have to keep our mind on that. And we have to keep our mind on how inflation itself is affecting individuals and their spending patterns, and how all the other things going on, policy uncertainty, what we would often call it. People, when they feel uncertain about what the future of our government is, then they actually tend to withhold their spending a little bit, especially if they're a firm. So all of those factors go in, but ultimately what the job of a policymaker at the Fed is to work with the economy we have as we see it today and work toward the economy we want. And that balancing act of managing the issues that come up today, but always having our minds on where we're trying to head, full employment and price stability, is the job we take on. And that's why we've become, over our history, so data dependent. We read every piece of data we can possibly get our hands on, and we talk to contacts, firms, community leaders, households, small businesses, everything to source the information so that we can do our best policy. And of course, if you're in anything in life, you do your best job one day and then you remain humble about what you still need to learn in order to do your best job the next day.
Speaking of data, I have a great question from a member in our stream. And by the way, we've got people joining us from all over the world present daily. I'm going to say hi to a few. Alex from Dubai, Lydia from Malaysia, Tanya from South Carolina, Tracy from Texas. Thank you for watching LinkedIn News Live. And if you have questions for Present Daily, please put it in the stream. Donald asks, Present Daily, can you comment on initiatives to reinvent macro indicators to both better capture reality in the modern economy and bring visibility to the effects of macro policy on subgroups?
Sure, absolutely. So over my career, let's just do the 25 years I've worked in this area, we've gone from thinking that we knew enough if we just looked at the aggregate information, the unemployment rate, the inflation rate, the growth rate of the economy, to really recognizing that you have to disaggregate all of those and ask, how are individuals in our economy by group experiencing those things? So what's the unemployment rate by race and gender? What is it by geography, by industry? How do people with less formal schooling fare in our economy relative to people with more formal schooling? And all of those things are helpful because you actually understand better how people are experiencing the economy, but you also can forecast trends in the economy more completely if you understand who has income, who doesn't, who's included in the expansion, who isn't. And that's why in our framework that we released in 2020 for the Fed, we said the labor market and full employment is a broad and inclusive goal, which really focuses on those data. And you talk about modernizing it, the work never stops for modernizing the data. In the pandemic, we all became armchair epidemiologists, if you will, and I use armchair in a way that is humble about we're not epidemiologists, but we had to learn about what does a pandemic do and how does it affect different groups? Because remember, this was a tale of two pandemics. If you worked in the high contact sectors, your careers were often decimated. If you worked at home, you were pretty okay. You managed a more stable existence through the pandemic. And so just knowing that is good because it helps us do better policy. It's the remembering that is critical because it helps us make better policy for the future. So I really appreciate the question. The work is never done. If any of you out there as listeners have ideas for what data we should collect, our doors are always open. We listen and we learn.
And I think we have pretty cool data. I'll just add that in. Happy to share. Sorry, Nina, go back to the questions.
No, so I was going to actually ask, we mentioned full employment and how monetary policy can sort of achieve that across the various groups here in the United States. What is the role of the Federal Reserve in helping close, say, the wealth disparity gap that we see? Can monetary policy fix this huge problem happening in the United States right now?
So the thing about monetary policy, and I always start with this, is we have two goals, full employment and price stability, and we have one tool, the interest rate. So we're already somewhat constrained in doing our work as effectively as many would like us to do. But we also have a clear role to play in the economy. We cannot solve every problem. We cannot eliminate all the gaps we see in the labor market and wealth, but a foundation, if you will, the fundamental to having any chance at doing those things is to have an economy that is sustainably growing. So a durable expansion, one that lasts for a long period, is the single best way to close gaps across groups. And you saw this in the last expansion, which I myself have studied along with the 1990s. And what you see in those two expansions is the longer they lasted, the narrower the gaps got between blacks and whites, men and women, all kinds of ethnicities, less formally educated, more formally educated. Their gaps in wealth, in income, in the labor market were shrinking. And that has to do with the fact that after a long time of having an expansion, employers take more risks. They hire workers that might not have every single credential. The way I describe it is we start by looking for, I think, purple squirrels is often the moniker, or unicorns. When the labor market is really loose, it's easy to find workers and hard to find jobs. And then we go to thinking, I wonder if all those credentials we've piled onto the job description actually are meaningful or just easy ways for us to screen people. And I think that an inclusive economy actually relies on us having a durable enough expansion that employers say, what do we really need? What skills and abilities do we need? That's why I like the LinkedIn profile so much. You're not endorsing credentials that are just degrees. You're actually saying, can you endorse a skill or an ability? And I think if we can move to a world with skills and abilities being top of mind, then that's something that will build an inclusive economy, and a long expansion does that. So that's the Fed's role. Create the conditions that allow for the long and durable expansion that we need as a starting point for the things that we aspire to be.
I love what you just said. Here at LinkedIn, we're very focused on skills-based hiring, the idea that hire people for the skills, for the job they can do, for the potential and their capacity to learn more and do more, and not on just the credentials. And I say that as someone who's spent a long time getting credentials, but it's all about skills. So love that. Can I keep you on the topic of equity for one more minute? We spend a lot of time looking at exactly the things you talk about. And we've looked at equity through the lens of gender. And obviously we know that women, how they fared during the pandemic, it wasn't great. It was pretty rough. They bounced back because women are resilient. But we're now looking at how women are faring over time, trying to get to the C-suite, trying to get to that leadership level. And it's pretty tough. It seems like as they progress, they become a smaller and smaller share of the cohort to the point where they get to the C-suite, and it's only 25% of them. So I wonder if you could just talk a little bit about how the Fed thinks about equity and making trade-offs when it's policy setting, and if you have any views on equity and the importance of it.
Absolutely. So let me start with the Fed and how we think about policy. So as I said in our framework, we stated right in the framework that full employment is a broad and inclusive goal. And so creating conditions that aren't satisfied simply when the average unemployment rate reaches a particular level, but recognizing that you want to keep going until you see groups in general coming out. So that disaggregated data. And it doesn't mean targeting every single group or looking at across the board and make sure everyone's unemployment rate is the same, whatever group they're in, but it means ensuring that we don't stop short of a full employment expansion, and we ensure that everyone has an opportunity. So that's what we do. And I just mentioned also try to create a sustainable expansion. I would offer that that's our Fed policy tool. But the Federal Reserve also employs almost 20,000 people in the United States across the system. So in the 12 reserve banks and at the Board of Governors. And here we employ almost 2,000 people here in the San Francisco office, and we in our 5 locations actually. And when you think about that, we have to be thought leaders and leaders of practice in equity. And let me give you an example. If you look at those statistics you just showed about how women progress, and this could be women, it could be people of color, it could be people from a lower SES, people with less formal education. You can use anything that is different, and you could look over that period and you'd say, well, we're good at getting them in and not as effective at having them advance. And I think it comes back to something you said, Karen, that I want to pull up on. You said that women are resilient. And we often say that about people of color and people from less advantage. Wow, they're resilient. So you start out being resilient, but if you have to be resilient at every step of your career, there's a wearing down effect, right? And then if employers and groups aren't lifting you and giving those equal advantages throughout, then that can just end in the kind of statistics we see. And we do see this, and I've done some work on this. What happens to career ladders? Well, people just fall off of the career ladder. And then you ask them, why did they fall off? And it's a whole host of reasons. They just got tired of the fight. They didn't feel like they had the same tap on the shoulder that other people had. There weren't fair postings. There weren't opportunities. People weren't encouraging them to apply. There weren't the flexible spaces for work that people need if they're going to navigate having families or taking care of their parents or whatever it is and going through their career. So I think the commitment that employers have to make, and we will start with us and hopefully lead others, is we have to change the workforce so that it's not every once in a while someone escapes through that maze of resilience and manages to get to the top and then we admire them. Why wouldn't it be that we should use that as a norm? And if we don't see it as a norm, then something in the process is broken. And so that's what we're doing, is we're taking ownership over that process. Until we see more equality in those statistics, then we have to imagine we have something to do with it that's limiting that growth.
President Daly, I want to pause the conversation very quickly, say hi to some more members who are joining us. William from California, Katrina from Tennessee, John from Chicago, Regina from Indiana, and Ishmael from Nigeria. Thanks for joining the show. And we have a question, President Daly, from Edward. He asks, what data and tools does the Fed use to evaluate what the Department of Labor calls climate-related financial risk?
So right now, the Board of Governors is working in partnership with all the other regulators. It's not the role of the Fed to create those measures. It's actually the SEC, but we're working in conjunction with them. And of course, here in San Francisco, we have a whole group of people who are looking at what indicators should we be thinking about or developing to understand what climate risk in terms of what it does to the economy, what threats it poses to the economy, how it just changes the allocation across the economy. So right now, I wouldn't be able to give you specifics on what exact things we're going to ultimately used to measure it. But I will say there are many people working on this issue, not only in the system, but across the regulatory environment and across the economics environment, because, climate feels almost like an existential risk, one that's going to come way far away. But if you're living in California or many other parts of the country or the world, it's already here, and you see it changing the patterns of economic activity, changing the patterns of financial intermediation, how many people can get financing, who people can get insurance for their properties or their businesses. And those are things we have to fundamentally understand. And fundamentally understanding requires actually measuring them and knowing what is happening there. So the SEC, as you might know, is developing a set of metrics, but there's a lot more work to do before I think we're satisfied that we have what we need to be able to do this effectively and fairly across businesses and communities and countries.
On the topic of metrics, I have to ask you, since you're here, all economists seem to have one or two of their favorite go-to metrics for kind of gauging where things are. Do you have any that you like to look at when you're trying to figure out just what's going on? Anything in particular?
Sure. So I'm perhaps because I don't think any particular statistic is going to tell me everything. I'm a preponderance of evidence person, and that's also my training in labor economics. You never really know anything with a capital T truth, so you end up sourcing a lot of information. So on my dashboard would be all the regular statistics for the economy that we have, the nationally published ones. But importantly, on my dashboard would also be things that people might not think of, like the quits rate. I also look at the churn rate in the economy. If I see people churning through jobs at rapid speeds, then I'm worried about the economy, because, I'm going to return to these LinkedIn profiles. Think of your LinkedIn profile. If you only spent 2 months at every job, you wouldn't really have a lot of people in your portfolio who could endorse you or say, oh yes, I'll vouch for that person's skills and abilities, because you only met him for 2 months. And so I think of that churn rate as being an indication that things are a little bit out of balance or unstable. And in terms of the broader economy, right now I'm looking at sentiment, consumer sentiment in particular, and small business sentiment. They don't feel it's a good time to manage their growth and for their household or their business, because inflation is so high. So that's a real indication to me that this is a painful, I can go to the gas pump and see it, but when you also read it in these aggregated statistics on sentiment, you see that it's having a pretty pervasive effect. And it's just, picking apart the data and not being satisfied with one statistic, I think, is the way to make good policy. You never know unless you look at everything what really is going on underneath.
President Daly, have those measures that you look at changed over the past 2 years, considering all of the sort of nonstop shocks that we've had to the economy?
They have, and they've changed in ways that both seem reasonable but somewhat surprising. So let me start with where we were, and this was the thing that kind of surprised me, is during the pandemic, and so not the very depths, not the first 3 months when we were just trying to figure out even what caused the spread of COVID, but when we kind of understood the science and we were then trying to figure out how to manage its impact, the sentiment was good. People they were out there spending, they had money, they had savings, we were constrained from a lot of the activities, and so we were pouring our resources into goods. And a lot of us using online shopping is the only way we could participate in the economy. And so that was really strong. And I was surprised again and again at the resiliency of the economy and consumer and business sentiment during the pandemic, despite the tremendous hardships that businesses were facing, especially small businesses. But as we came through it, and we got a few ideas that we would just kind of escape this, but then inflation started to build and we really didn't get through the pandemic as quickly or as easily as we had hoped. Then I started to see the sentiment slip, and some of the statistics that would indicate future progress slip with it. And so that's what my eyes are on right now, is that, we started our conversation with, many are worried that the Fed might be acting too aggressively and maybe tip the economy into recession. I'm myself worried that left unbridled, inflation would be a major constraint and threat to the U.S. economy and its continued expansion. And so getting that right and getting people to feel comfortable that the dollar they earn today will pay for the goods they want tomorrow, that is no longer something people feel that confident in, and we've got to restore that confidence. And when people have that confidence and look around and see those indices that you just showed me, Karen, earlier about hiring rates and other things, we're going to have an economy that self-sustains itself forward. And that's what I'm working towards.
Before I let you go, President Daly, there's a lot of comments in the stream asking about recent layoffs, or we have Christine who is talking about how she has, inflation she's tapping out of her investments and her savings because of inflation. It seems that people would love to have some guidance on just how to navigate this uncertainty. This high prices for goods, and just uncertain times with mass layoffs that are starting to happen. What is your advice, President Daly?
Okay, great. I will take on those questions, but I'll take them on separately for a moment. So let me start with the inflation part. So let me just acknowledge that we're in a tough time right now. If you're buying gas, paying rent, or paying for your house and buying food, you're feeling the pain. And so that we just have to acknowledge it is tough right now, but it will be getting better. And it will be getting better in part because of the Fed's policy actions that are restraining demand, but we're also starting to see some signs of life in supply chains. And as those signs of life translate into actual delivery of goods, we will see some relief on inflation. We're also, if the airports are any indication, we are also re-entering the world of service consumption. All of us as consumers, we're participating in vacations, we're going to restaurants, and if we can keep COVID behind us, or at least at bay, then we can continue to do those things, and that will also be some relief on the pressure of inflation. So I recognize it's tough right now, and we have to get through it, but I am working hard, and all the Fed policymakers are as well, to get that back down to levels that are at least going in the right direction and moving back towards a more tolerable place, and ultimately to our price stability goal of 2%. So that's on the inflation front. On the jobs front, there is a lot of turmoil. And if you open the newspapers, it says that there are mass layoffs, especially in tech. But that's not directly related, or not only related would be the better phrase, to the slowing of the economy. I mean, tech is always repositioning itself. It tends to get a little bit over its skis, if you will, in an area, and then come back and settle into a more steady state progression. And tech was always going to have to make some adjustment because it was completely the sector of choice during the pandemic, as everyone repositioned to get the technology they needed to manage working from home. But as that alters itself, or take crypto, which has just gone through a big rise and is now getting back onto some more level, more regular playing field with itself. So that's going to cause things. But there is no time where being a tech worker isn't an advantage in terms of finding another job. The labor market is very strong right now, and you saw it in Karen's data, despite the layoffs. So it is disruptive. It feels quite uncertain. It can be very unnerving, but I am quite hopeful that if you're in tech especially, you'll be able to continue to get jobs. And the other sectors are not closing down, they're just repositioning. And oftentimes they can't fill the jobs they have. So you might have to move jobs, but I'm not worried you won't have one.
President Daly, thank you so much for spending time with us today and for speaking to our members here on LinkedIn.
Thank you. It was quite a pleasure. Thank you.
Please come on again soon.
Anytime.
And I want to thank Karen Kimbrough, our chief economist at LinkedIn. Thanks for being my co-host today. This is a lot of fun.
It was fun. Thanks for having me.
And thank you for everyone who submitted questions and comments. Very sorry we couldn't get to everything, but please continue the conversation here on the stream. If you'd like, you can check out some of our other stories to the right of your feed, or if you're on mobile, just click into the search box. Next week, we are out for the 4th of July holiday. Please stay cool and safe, everyone. Thank you for watching LinkedIn News Live.